In the session for today, we'll try to analyze a global dashboard, right? So for all the people who are watching the session, I'll just share my screen and we'll be discussing upon a few of the metrics regarding the global dashboard. And that is a dashboard which has tried to encapsulate each and every parameter from a macro number to basically the returns perspective from all the markets, be it the developed markets or emerging markets and all those things. So I'll be just sharing up my screen with you, and hopefully that data point will give you a very clear-cut understanding about what has happened in the FY25, right? So we are starting with the FY26. FY26 has already started. And for many of you who have confusions about how to analyze these fiscal years and different other things, see, one thing is, if you're talking about an FY25, so an FY25 starts from the 1st of April 2024 and ends as of 31st March 2025, right? And if you're talking about the FY26, it talks about from the 1st of April 2025 to 31st of March 2026, right? So that is something we need to understand, because many of the times people tend to have these confusions that what do we mean by this FY25, FY24, FY23, right? So we have just ended FY25, that is the financial year. So basically in India, we tend to follow the financial year from April to March, 1st of April to 31st March. So the FY25 is over now. That is from 1st of April 2024 to 31st of March 2025. And now we're beginning with the FY26, that is 1st of April 2025 to 31st of March 2026, and so on. Right, so all the projections you see in the Indian markets are based upon the FY multiples, right? FY24, FY27 projected earnings, FY28 projected earnings, FY29 projected earnings. But if we talk about the global markets apart from India, especially if we talk about US and European markets, they tend to follow the financial year from Jan to December. So their financial year is same as calendar year. If we talk about economies like Japan, they follow the financial year from 1st of October to 30th of September, right? But majorly, the global economies are following from Jan to December. But India, as an emerging economy, we tend to follow fiscal year. That is from 1st of April to 31st of March. Now, all this data which you tend to see here is as of 31st March, be it for the global markets or the Indian markets, just to have a kind of a realistic comparison, right? So all these data like which you see in here, be it for Europe, be it for US, right? Or be it you see for like any other kind of country, be it France, be it Germany, every data is from 1st of April 2024 to 31st of March 2025 for the sake of realistic comparison. And what's the reason why I have taken data from this parameter or this timeline only, having, I would say that different countries having different financial years, just to have a realistic comparison. So for example, if in India, I took the financial year from 1st of April 2024 and 31st of March 2025, right? But for US and Europe, I took like 1st of April 2024 to 31st of December 2024. It won't make a realistic comparison. That is why all the numbers that you see here are for the same timeline, which have been adjusted towards the Indian financial year, right? So all this data point, again, this data is being published by Motilal Oswal Asset Management. And if you see in here for the Indian market update, so first of all, we'll try to analyze the Indian market update, and we'll try to relate all these returns, all these metrics, and all the parameters that we see in here with respect to what's happening in the global markets. We'll try to include some impact of tariffs as well, right? So first of all, if we see the Indian market slide, so in this Indian market slide, if you see about the returns, so these returns are as of 28th of March, deal 2025. Now it won't differ from like 28th of March to 31st of March, because you had a 2 or 3 holidays on like 29th, 30th, right? They were like 2 holidays, and 31st March was again a holiday, like if I'm not wrong, correct? So all these things came into place like on account of Eid, correct? So the last working day is as of 28th of March 2025, and all these returns are categorized for different indices. Now, here if you see, and one more thing, for all of those who are appearing for the corporate interviews of investment banking, equity research, investment specialist profiles, they should have a fair understanding about these returns. Now, here I do not mean exact returns, but at least a fair amount returns, a lump sum figure. So if you see these 1 year data, this 1 year data is from 1st of April 2024 to 31st of March 2025 or 1st of April 2024 to 28th of March 2025. This data has been taken into account. This data has been encapsulated from 1st of April 2024 to 28th of March or 31st of March 2025 because next 3 days were holidays. Okay. And why I'm stressing upon this 1 year data? Because 1 year data again is not so recommended. Ideally, we need to see at least 5 to 10 years data, but out of these numbers, be it 1 month data, 3 month data, 6 month data, 1 year is the most reliable data. Because it can happen that a specific sector or a specific index or indices, they performed marginally well in a particular month, but they might not outperform the other indices or sector, or they might now not even outperform or give green returns or positive returns on a 3 month or a 6 month basis. So on a 1 year basis, the performance tend to get averaged out. So if we tend to take into account 1 month, 3 months, 6 months, and 1 year, 1 year is the most realistic comparison because the performance can be too much fluctuating. The performance can be hugely volatile in a 1 month, 3 month, and 6 month basis. The stock market might rise over a 1 month basis. A specific sector might rise over a 1 month basis, but it might fall over a 3 months basis or a 6 months basis. But over a 1 year, you tend to see the different volatilities of the market. You tend to see the upside potential. You tend to see the downward trajectory of that market. And all these numbers, all these upsides and downsides, they get averaged out on a cumulative basis on a 1 year pattern. Hence, we shall be discussing on a 1 year basis only for all these indices or sectors, be it India, be it foreign, because 1 month, 3 month, and 6 month makes no sense from a financial perspective. For all of those who have entered into the market for long-term investment decisions, for all of those who are the current equity research analyst or investment specialist or portfolio managers, they tend to advise the clients or take the bets in the portfolio based upon long-term averages or long-term numbers, 1 year, 2 year, 3 year, 4 year, 5 year, and not just based upon a 1 month performance or a 3 month performance or a 6 month performance. At least 1 year needs to be taken into account because we're focusing towards investment decisions and not short-term trading decisions or scalping, right? In short-term trading, kind of short-term trading decisions, you might have a specific technical indicator based upon volatility, based upon VIX. That's the volatility index. How much risk or how much volatile a specific index has been over that particular time frame. So you tend to take into account multiple option chain analysis, your VIX, your implied volatility, strike price, right? All these things you tend to take into account and you tend to make a trading decision based upon these 1 month, 3 month, or a 6 month number. But we're ignoring the concept of volatility here, not entirely, but somewhat. And that is where we're taking a kind of an averaged out number on a 1 year basis. Hence, all the performances, all the returns shall be analyzed and discussed based upon 1 year performance only. So if you see Nifty 50, starting from, so all these numbers are from, again, I'll repeat this point, I'll reiterate, is from 1st of April 2024 to 31st of March 2025. So Nifty 50, your Nifty 50 on a 1 year basis has given you 5.34% return. Right from 1st of April 2024 to 31st of March 2025, Nifty 50 has given you 5.34% return. Again, that's not a very good number because if we talk about the calendar year, right from 1st of January 2024 to 31st of December 2024, Nifty 50 gave you an 8% return. Again, that was a higher single digit. In fiscal year, which India follows popularly from 1st of April 2024 to 31st of March 2025, Nifty 50 has given 5.34% return. Again, that was the expectation, a lower single digit or a mediocre single digit number of 5.34%, right? Because we have all seen about the higher valuations in the Indian markets, right? Though Nifty 50 has become fairly valued, or it has come down before the fair valuation target, it has become undervalued. If we talk about a 10-year price to earning multiple for Nifty 50, a 10 to 15-year price to earning multiple of like Nifty 50, it stands at 20.5x price to earning, right? The forward price to earning multiple I'm talking about, right? 20.5x, but currently it's trading at 19x, right? It's trading below the long-term 10-year, 15-year averages. Again, that's a very good number. If we specifically talk about the Nifty 50 or the index that comprises the top 50 market cap companies or the top 50 market capitalized companies, right? 5.34%. From the previous 3 to 4 quarters, or almost a year, we have seen the earnings downgrade for each and every sector. The earnings have got downgraded, right? Your corporate profitability. There is a specific metric. We talk about the corporate profit to the GDP ratio, right? I'll repeat, this ratio is called as a corporate profit to GDP ratio. Our corporate profit to GDP ratio as of now, it stands at 5.2%, highest ever, right? During the COVID-19 crisis, it came down to 1.1, 1.2%, the lowest ever. So the corporate profit to GDP is again at all times high, 5%, 5.1%, 5.2%. The valuations have also become very high, and the valuations are not supporting the earning growth. The corporate profitability as a percentage of GDP has peaked out now. And the earnings growth that we see in a single digit or a lower single digit, or maybe just for a few of the companies being at 10% or like max to max 11, 12%, their valuations are drastically high. The earnings growth is not supporting the valuation. As in our previous sessions, we have talked about the price to earning ratio. This tends to have price in the numerator and the EPS in the denominator. So EPS talks about the earning growth of these companies. So the earning growth of these companies were in higher single digit or lower single digit, but price of these companies was sheerly high. The earnings were not supporting the price, and hence these companies were labeled as sheerly overvalued and they started to correct, right? So these overvaluations were like one certain reasons. All these reasons pertaining to global tariffs for specific sectors, because all those sectors which got impacted by these tariffs, again, they also started to come down. They also started to have a downward trajectory, right? Within the Nifty 50 space or mid cap space or small cap space. So 5.34% is the number that Nifty 50 gave us over the past one fiscal year, from 1st of April 2024 to 31st of March 2025. Nifty next 50. Now it talks about the high growth potential companies which can become Nifty 50. It gave us 3.99%. So again, the Nifty next 50 was overvalued, was trading at a higher valuation as compared to Nifty 50, right? It just gave you a return of 4%, 3.99%. Nifty mid-cap 150, 7.62%. We have been talking about the Nifty mid-cap um things of overvaluation, right? The Nifty 50, the Nifty mid-cap 150, they became overvalued, right? The past year averages, they tend to trade at approximately 23x or 24x. Currently, they're trading at 27x forward price to earning multiple. Again, they're overvalued. But one thing we have seen for the mid-cap space is the mid-cap, still, the mid-cap, despite being overvalued, was able to beat the Nifty 50. The Nifty mid-cap 150, despite being overvalued, was able to beat the Nifty 50. And also we can see the valuations of Nifty 150 index, the Nifty 150 mid-cap index, from 30x odd, 32x odd, has come down to 27x. It means earnings are there. Because if we talk about the price to earning multiple, price in the numerator and EPS in the denominator, if the EPS is rising, the earning growth is coming up, right? The price to earning will come down. So if this price to earning ratio for the mid cap has come down from 32x forward price to earning multiple or 33x forward price to earning multiple to 26x, 27x, it clearly states the earnings are strong. The earnings are much more stronger as compared to the large cap index. Then why not go for the mid cap index? We have been talking about sheerly overvaluation. Sell off mid cap, sell off mid cap, but the mid cap is one of the strongest indices. The companies which comprise the mid cap index 150, they have the highest potential of becoming large cap. The probability by which the mid cap companies can become large cap is much higher versus the probability of a small cap company becoming a mid cap company. Many of the small cap companies go off the market. They go into bankruptcy, they become micro cap, they got the most of penny stocks, got pump and dump and so on. But fundamentally strong mid cap companies, they enter into the Nifty next 50 and also become the Nifty 50 companies. So earnings are there in the mid cap companies. Also, one more data point I will tell you. If we talk about the FY21 to FY24 year, past में जो हुआ, the FY21 to FY24, your large cap Nifty 50, right? They grew by approximately 20%. They grew by approximately, give me a second. I'll just have this. Just give me a second. So basically, if I talk about the FY21 to FY24, the Nifty 50 grew by 20%. The mid cap index grew by 40%. The mid cap index, it grew by 40%. And small cap grew by approximately 38%. Right? But if I talk about the forward projections from the FY26 to FY28 expected, the Nifty 50 is expected to grow by just 10%. The mid cap index is expected to grow by 20.5%. And the small cap index is expected to grow at 17.9%. And all these numbers are the EPS CAGR. I'm talking about the CAGR growth in terms of EPS by how much the profitability of these companies is expected to grow. Past में they grew by those percentages. Some 20% odd EPS CAGR, FY21 to FY24 for large cap, some 40% for mid cap, and 38% for small cap. But for the projected numbers, like which are of utmost importance for an investor to make an informed decision, that is how much and whether to go for a large cap space, a mid cap space, or a small cap space. So FY25 to FY28 expected, the Nifty 50 EPS CAGR is expected to grow by 10.5%. FY25 to FY28 expected EPS CAGR for the mid cap index expected to grow by 20.5%. FY25 to FY26 to your FY28 expected, right? EPS CAGR for small cap expected to grow by 17.9%. Again, the mid cap EPS CAGR is expected to grow by much more quantum than large cap and small cap, right? Based upon earnings. I'll share those numbers with you based upon specific calculations. So why not go for the mid cap space? The Nifty small cap, again, 5.4%. So Nifty small cap and Nifty 50 have almost given same returns. Then why anyone had gone for Nifty 50 and not Nifty small cap? Nifty micro cap 9.11% under research space. There was a study by multiple organizations, multiple research firms that Nifty micro cap or the micro cap indices or micro cap stocks are the most under researched stocks. People do not tend to do some research upon these stocks. They ignore such stocks. So majorly all the research by different analysts is being done on large cap space, upon mid cap space and small cap space, but not upon the micro cap space, right? Micro cap space is the under penetrated space, under research space. And that is something we need to know. 9.11% beating the large cap, small cap, everyone, right? Nifty 500, it's an average return for the large cap, mid cap, and small cap. Around 80 to 85% is large cap in Nifty 500, right? And the remaining around like 15% is the composition of the mid cap and small cap, correct? So 75 to 80% is the weightage for Nifty 50, and the remaining weightage be like 20% odd or like 25% odd is towards the mid cap and small cap. So majorly the maximum return is coming up in Nifty 500 by what? By your large cap companies, right? Now, if we see sector wise, all the sectors have been positive from 1st of April 2024 to 31st of March 25, FY25 May. Banks were positive. We talk about banks not giving returns, 9.4%, 9.42% returns, beating the indices. Because these numbers clearly show you that it's good to watch like different news platforms. Like we say that the financial services is not doing good, the banking is not doing good. But when you get the actual numbers, you get to know that these specific sectors have beaten other indices. Then why hadn't we gone for those sectors? So it's important to do your own research upon the fundamentals of stocks and fundamentals of sectors, despite just listening to the news channels like CNBC or Z Business or the NDTV Profit that they are saying, or some top analyst or the management of the company has come into place and saying that we expect the banking will not do good, or we expect just the auto will do good, or just the metal will do good, or just the FMCG will do good. You have to do your own research. So if anyone had invested into the banking space, again, he would have beaten the Nifty micro cap, right? So every sector had been positive apart from auto being negative by 0.58%, energy being negative by 13.96%, FMCG again negative by 0.67%, and reality 5.48%. Maximum negative has been seen in the energy sector. There can be multiple reasons out of tariffs and different scenarios. And the highest return has been seen in your healthcare, in your defense sector, 37.91. It got rebounded in the previous 2 months also, but the maximum return has been seen in defense. It has been seen in healthcare. It has been seen in metals, 10.12%. People were trashing down metals, sell off metals, tariffs, XYZ stuff. Though the futuristic projections for metals are not so strong, but historically, over the past FY25, they have given returns. Now, if we talk about the smart beta strategies, right, or factor strategies, The majority of the mutual fund houses or the asset management companies are coming up with these factor funds or smart beta funds that tend to take into account a specific factor, right? So for example, you might have a specific fund that captures the price trend, and the price trend is based upon momentum. You see the price trend over the past 3 months or 6 months or 8 month basis, and then to add those stocks based upon a positive price trend. So if we talk about a momentum strategy, a momentum index fund or a Nifty momentum ETF, it has gone down by minus 4.5%, a negative return, because we have seen over the past 1 year, momentum has fallen because we have seen a negative price trend. And in a negative cycle, this smart beta or this factor of momentum doesn't work well. The momentum always works well in a bullish market when everything is rising. Then you have a low wall. Again, this low wall, it works well. It works well in a recovery phase when the market is recovering from a crash or a depression or a bearish phase. So in those cycles, in a recovery cycle, this low wall and quality works. So low wall has given you fairly decent 0.13% return, but quality has fallen down by 7.6% because earnings had also fallen down, and the quality of the earnings, the qualities of the financial projections were in question. So in this phase of market, when the market is in a phase of consolidation or the market might recover, it's not a bearish phase. It's more of a phase of consolidation. Low vol and high quality stocks or low vol or high quality funds having these as factors or smart betas of low vol and quality can do really good. Again, enhanced value. They tend to figure out undervalued stocks. Now, in this market, it's very difficult to find out undervalued stocks. We might find out in the large cap space, right? But it has given you a fairly decent return of 1.88%. So in a bullish phase, we tend to have this beta of momentum. In a bearish phase, we tend to have enhanced value. In a recovery phase or a consolidation phase, as we can see right now, low vol plus quality factor funds, low vol plus quality smart beta funds or ETFs can give you good returns. Okay. Now fixed income. If you see a Nifty 5 year, a 10 year, right? All these has beaten Nifty 50. And that is why if we talk about previous years, in previous years, like what was happening? In the previous year, many of the global analysts or many of the global fund managers, they suggested people to include fixed income in the portfolios. They're told that this fiscal year 25, it might not be a very good year for equities, be it Nifty 50, Nifty small cap, Nifty mid cap, right? Everyone was suggesting to have certain proportion, not everything, the majority 60 to 70% should be all equities only, right? But they suggested to have a mix or a flavor of the fixed income. Usually, if we talk about the global markets, in the global markets, they popularly talk about a 60-40 portfolio, 60% equities and 40% debt, right? And they have a blended benchmark. And what do I mean by a blended benchmark? In a blended benchmark, they again have a 60% composition towards equity and 40% towards fixed income. So if we talk about the US markets in a 60-40 portfolio, this portfolio is very popular. The undervaluation of this portfolio is also compared with the benchmark. The undervaluation or the overvaluation of this portfolio is also compared with the 60-40 blended benchmark. So 60% equities, 40% fixed income. So 60% ka benchmark is your basically your MSCI, right? The Morgan Stanley Capital International Index comprising of all the stocks of US. And that 40% composition is towards Barclays Bloomberg Aggregate Index. Barclays Bloomberg Aggregate Index, it captures the fixed income market, the government bonds, the corporate bonds, high yield, and the IG bonds. So on dono benchmarks ko separately, this benchmark for the MSCI is separate, the Barclays Aggregate Index is separate. Again, these two indices by the backend mathematical calculations have been blended, and this has been made the benchmark of the 60-40 portfolio. So the major aim of the 60-40 portfolio is to beat this blended benchmark. And all these calculations are being done that whether our portfolio of 60-40 is undervalued as compared to the valuation of the blended benchmark or overvalued. So all this kind of studies being done. And this study is also being done in India as well, right? You have different indices for equities, for fixed income. So if you see all these numbers, especially for your Nifty 5-year, 10-year, it has beaten even the micro cap space as well. Micro cap stands at 9.11. The Nifty 10-year at 9.86 and 5-year at 9.43. Your long duration debt 9.01, again higher than small cap and mid cap. So those people or those investors who had certain composition in the fixed income, they were able to beat the equities as well. And if you see this chart, you see that for the Nifty return of this 5.34%, maximum contribution has been made by the financial services by 2.48%, then industrials 1.01%, and then commodities. And every time we used to say the sell of financial services, the sell of banks, PSUs, private, insurance, brokerage, बस बेच दो बेच दो बेच दो. But जो निफ्टी 50 का 5.43% का 5.34% का रिटर्न है, to be precise, 2.48 comprises of these financial services, 1.01 out of industrials, and the 0.84 out of commodities. So why didn't we go for financial services in the previous year? Though not a very good return, 5.34%, it's very low. And like one of the reasons why the FIIs also have not come completely back towards the Indian markets, because there they're getting around like 4.5%, 4.2% in USD. यहाँ पे like it is 5.34%. If we adjust it against the currency depreciation by 2% or like 3% or 5.34% minus 3%, it gives you 2.34%. So their 4.2%, 4.4% is much better than this 2.3% USD adjusted, or by taking into account this impact of currency depreciation. So ideally, after taking into impact the currency depreciation को include करने के बाद भी, our returns will be more than 5% to make a US investor, FIIs, invest in Indian markets, right? So this was morely about the Indian markets. If we see the US markets, or basically a composition of the emerging markets and developed markets, S&P 500 6.22% beating India, Nasdaq 5.62%. Again, these have corrected by like 15-20% odd now. Dow Jones 4.46%. So Dow Jones hasn't been able to beat the Nifty 50. But again, your Nifty mid cap and Nifty small cap have outperformed these indices. Of course, in the terms of INR, but if we adjust it against the USD, they have still underperformed, right? So at least after adjusting the impact of currency depreciation, our markets should give more than the foreign markets, more than the S&P or Nasdaq and Dow Jones. Only after that, the FIIs will come back into India. China, 38.59%. Just see 38.59% Chinese markets. And that is why we say Chinese markets, most of the sectors in the China have become overvalued or at least fairly valued. And earlier to the previous year, like many of the people fled to China, or many of the portfolio managers took short-term bets or tactical bets in Chinese markets. But now they have come to take more of a long-term bet or a strategical bet, because Chinese markets have become appealing to them, right? So tactical bets say, short-term say, they've come towards a more longer strategical bet. But all these tariffs concerns will again make the coming back to India, right? Taiwan 8.26%. Korea and Brazil are negative since past 2 years, past two financial years, calendar years, or the fiscal year, surely negative. Even South Africa market is positive at 27.84% return. So if someone asks you in your emerging markets, China is positive, Taiwan is positive, and South Africa is positive. China, Taiwan, and South Africa. But Brazil and Korean markets are negative in terms of returns. For the developed markets, United Kingdom, 11.3%. Again, Japan and France have been negative for past two calendar years or fiscal years, right? The Switzerland is positive and Germany is also positive. For commodities, we have seen crude going down to as low as $62 to $64 per barrel, right? Down by 16%. Gold has been up by 38%. Silver has outperformed gold in the previous fiscal year, 40%. Because people are saying that silver is about to become the new gold, because gold has almost reached the full potential. But silver has various industrial uses also, in solar panels, in defense, in wires, kind of electricals equipments, in cars, in automobiles, and silver is widely used. So that is why the demand for silver is bound to rise in future. So it has outperformed by approximately like 1.52%. And again, USD INR. The USD has appreciated by 2.48% against INR. For Bitcoin, like 21%, Ether has fallen. And that is why I have always been suggesting people to go for Bitcoin and not for other cryptos. So Bitcoin again has no fundamentals, but if we compare the other cryptos, like Bitcoin is the strongest one, because it has a sufficient supply, a sufficient limit out of which you can reach that. And the return contribution for the S&P index that you have seen, right? So basically what you see for the global market update, IT being a major contributor towards negative performance. Then consumer discretionary and communication services, because all these top companies, your FANG, right? Your Facebook, Meta, Amazon, Tesla, all these, they fell by a greater margin, right? But if someone asks you that, which markets have been positive in the emerging sector, China, Taiwan, and South Africa. So basically, these different countries you should know. In your developed markets, the UK was positive, right? Your France and Japan were the only negatives. But Switzerland was positive, Germany was positive. Okay. Again, these are some macro numbers for India and the US. We tend to talk about the unemployment rate in US, right? At around 4.1%. But we do not talk about the unemployment rate in India. Now, this rate has come down. In the previous fiscal year, it was 8%. Now, it has come down to 7.8%. Fairly good, but not so much good. Our CPI, 3.61. The latest number as of March came out, right? We had the number as of 3.61, right? The repo rate, it's 6% as of now, right? In the previous week, we had a 25 basis points cut from 6.25% to 6%. So ignore this number. But reps, your tri-party repo agreements at 6.18%, your 10-year yield, all these numbers are here. In March, FIS inflows were 32 lakh crores, 32,000 crores, right? And outflows for DIIs were 74,000 crores. So usually in the previous month, we have seen the DIIs outpacing the FIS outflows, or DIIs matching, or DIIs inflows matching the FIS outflows. But in this month of March, we saw DIIs selling much more as compared to the FIS inflows, because March was the very first month in years when FIS turned positive. Now in April, again, they've started to sell around like 4,000 crores, 5,000 crores every day. They are selling in April, right? GST collection is strong. US में again this inflation is coming down. You have a 10-year yield. You have the US PMI. Again, this PMI being more than 50 is really good. India 58.60 and US PMI for the US being 53.50. Again, very good. Now this is around $296 billion. Again, the US tax receipts, the same as GST collections in India. So all these numbers have been fairly good for both US and India, right? So all these numbers are something which are very important that need to be understood. अब यहाँ पे the thing is now, if we talk about this repo rate, now in India, this repo rate has come down from 6.25% to 6%. Okay, this repo rate has come down from 6.25% to 6%, right? But the thing is, so what is basically happening? If you have seen Mr. Uday Kotak talking about the bank liquidity, they're saying the banks tend to operate at a negative spread. And what do I mean by this negative spread? See, so first of all, we need to understand that what exactly is spread. Spread is the rate at which the banks are taking loan minus the rate at which that they are like giving you loans. So for example, if the bank takes loan at a 7% rate of interest, the bank will give loan to you at 8% rate of interest or 9% rate of interest or 10% rate of interest, because the bank has to make a profit, right? So at 7%, the bank took the loan. At 10%, it gave it to you. So 10 minus 7%, 3% is the spread or the net interest margin as a percentage of total assets the bank makes. Correct? But what has happened over the previous years or previous few months is the banks had to garner more deposits, because basically what happens for most of the banks, the C by D ratio, the credit to deposit ratio rose more than 100%. And that was a warning signal, because the maximum money was going into equities. They were like withdrawals from basically from various tax accounts, right? And all these kinds of stuffs. So they had to garner deposits, because deposits form the crux for any banks. So to garner deposits, they had to increase the rate of interest on deposits. So what basically happened, the rate of interest they were trying to give on deposits, they outpaced the rate of interests that they were getting, right? Because what basically happens if we talk about a banking system balance sheet, right? So how does a banking balance sheet look like? In the asset sides, right, you basically have some bonds, right? Those government bonds or treasury bonds on which you have to get interest, or some corporate bonds per se, or like some kinds of bonds per se. And you have the FX, right? The FX reserves around like 680 billion as of now. On the liability side, you have the deposits on which you have to pay interests, right? You have deposits, you have the cash in circulation, the currency again, because it's a liability, and you have equity. Correct. So what basically happens if you are paying more interest on deposits, right? And the rate at which you are giving out loan, right, is less, because you had to garner more deposits, and ज्यादा deposits लेने के लिए तुमने deposit पे ज्यादा interest rate pay कर दिया, right? So this spread starts to compress. The spread has started to compress, and the spread has turned out to be negative for various banks, especially in your unsecured lending and microfinance, right? Because till last year, the credit growth in the economy was 18%, 19%. It has come down to 10% now. The deposit growth has outperformed the credit growth now. The deposit growth is growing at 10% or like 10.5%, but deposit growth is growing by some 11.5% now. They've come to a stance, they've come to normal circumstances. The credit to deposit ratio for 100% has come down to 80%, 85% odd for various private banks and public banks. The major problem was with the private banks only, the PSUs were safe, right? So the thing is, now if to garner more deposits, the deposit rates had to rise and the loans and the rate at which they were like giving out loans remains same. Either the spreads compressed or they become negative. So banks were operating at a negative liquidity of 1 trillion rupees and the spreads compressed. And now since interest rates are also coming down, this NIM compression will hit hard because again, the rate at which they're giving out loans has to come down and the deposit loans and the rate at which they're giving deposits will also come down. Or the thing that will happen is whenever you are reducing the interest rates, the rates at which we're giving out loans, because most of the loans are priced with the repo rate, right? So the effect of the change in the repo rate get priced first in the loans that the bank is giving out. तो जो rate of interest बैंक को पहले मिलना है पहले वो कम होगा and the rate at which the deposits will be reduced will be less. And the vice versa takes place in case of a rising interest rate environment. That whenever the interest rates are rising in the market, right, interest rates on loans get priced first versus deposits. And at that particular point of time, the banks make a lot of money until reaching equilibrium. But at this particular point of time, when the interest rates are coming down, the loans shall be repriced first. The rate at which we're giving out loans will be repriced first. And the deposits shall be repriced later after 3 months, 4 months. So the rate at which the deposits are repriced, it comes with a lag versus the interest rate at which the loans are given. तो लोन्स पे इंटरेस्ट रेट कम हो जाएंगे, बैंक्स को कम पैसा मिलेगा, बट डिपॉजिट्स पे उतना ही इंटरेस्ट रेट रहेगा. फॉर ऑल दोस बैंक्स which are having a positive spread, the spreads will be squeezed. For all those microfinance lenders, for all those unsecured lending, for all of those who have a lesser CASA, right, they might face negative spreads for 2 or 3 quarters. So at least for this particular point of time, the thesis is go for those banks who are having a higher CASA. Higher CASA means low cost of funding because they have to pay a lower interest upon saving deposits and no interest on current accounts. So those banks having higher CASA will always have a lower cost of funding, like HDFC Bank, ICICI Bank, Kotak to some extent. And these banks will not suffer. Their margins will be squeezed, but they will still operate at a positive spread. But all those unsecured things, right? All those unsecured lending, all those microfinance, like these kind of microfinance institutions, or all these kinds of different banks like Indocent, AU Small. Now, these are not stock recommendations, just for some educational purpose. I'm telling you, I'm not giving you any stock advice. You need not buy these stocks or sell these stocks based on my name, right? It's just for educational purpose. So all those banks having a good CASA, higher CASA, meaning low cost of funding, because banks pay less interest on saving deposits and no interest on current accounts, will do well. But those who are having lower deposits and lower CASA will have to pay more. Their cost of funding will be high, their NIMs shall be squeezed, and they might operate on negative spreads. NBFCs might do good because NBFCs mainly follow the business model of taking loan at a floating interest rate. वो loan लेते हैं on a floating interest rate, but they give out loan at a fixed interest rate. तो जितना NBFCs को देना है, that interest rate will come down. And the rate at which they have to give out loans, again, that will also come down, right? But they will be able to stay at a much more positive spread. So what will happen? They're taking loans at a floating interest rate. तो उनका interest rate हो गया कम. But those NBFCs who are lending at a fixed interest rate, now the interest rate for them will be fixed. अगर वो 9% पे दे रहे हैं, despite the fact the RBI has cut down interest rate, those guys shall be paying those NBFCs at 9% only. तो interest rate कम देंगे और उनको मिलेगा ज्यादा. Right? So NBFCs will do good. Strong NBFCs into transport businesses, into home loans. Right? So again, that is also one thing. So basically your home loans and all these kinds of industries, or home loans and corporate loans, they have a much sensitivity towards the change in interest rates. We talk about basically a sensitivity of lag. So the sensitivity of lag is much more higher in case of corporate loans or housing loans, right? Not even corporate loans, like much of housing loans, your home loans, your car loans, right? They tend to get repriced faster, or the demand tends to get stimulated much more when these kind of interest rates come down. But if you talk about corporate loans have a less sensitivity towards the reduction in the interest rates. For SME loans, your home loans, they have a higher sensitivity towards the reduction in the interest rates. If the interest rates have come down, more loans in terms of home loans, car loans, be it your SMEs, will be taken. But if the interest rates are coming down, more loans from the corporate side will not come into place immediately, because corporate loans are much more linked towards the growth in the economy, but how strong the economy is. Just if your economy is strong, if the economy is fundamentally strong, the corporate loans will increase despite of the fact the interest rates are lower high. So they get priced with a lag or have a lesser sensitivity beta towards a change in interest rates, right? So that is one thing we need to understand. Again, see, just to get more money, they're coming up with more instruments like certificate of deposits being priced higher than repo, because like what basically happens, the rate at which you are giving out money in the market is not exactly repo. It's priced at somewhat higher than repo, right? Be it at 7%, 8% per se to get that spread. So all these things we need to understand ideally. So all these were the global factors, these global parameters in terms of returns, in terms of macro indicators. And that is something we need to understand very diligently, right? So that was it for today. I hope all these things are clear with you. I'll be attaching the link of this PDF, right? Like very nice PDF by Motilal Oswal Asset Management, right? I'll be just attaching this PDF in the description box as well. And I would really insist everybody to subscribe and press the bell icon and like and comment upon the videos. If you're liking them, then well and good, right? Just share your positive commentary. Just share with as many people as you can. If not, just tell the reasons for update. We're happy to improve the content. We're happy to improve the way of teaching. And so again, that is also which is something we are like more than happy to improve, because the quality of content that we're getting here is something that you will get nowhere. I try to summarize the content in the best possible manner, जितना easily हम content को summarize कर सकते हैं वो मैं करने की कोशिश करता हूँ, right? There are no fancy terminologies, no fancy interpretations, no fancy kind of representations, right? Via PPTs, via digital content or something. It's all very basic, just sharing screens and giving you the most fruitful content in a much more easier manner, right? So feel free to connect with me and do not forget to subscribe and press the bell icon. Okay. Thank you so much, guys. See you.